The Great Depression was the most devastating economic crisis of the modern era. In just a few short years, booming cities fell silent, businesses closed their doors, and millions of families watched the lives they had spent years building slowly fall apart. The optimism of the 1920s gave way to uncertainty, unemployment, and endless lines of people simply hoping for their next meal. And this wasn't just America's crisis. Its effects spread far beyond Wall Street, shaking economies across the world, fueling political instability, and helping shape the events that would eventually lead to another global war. But how did it all happen? How could one of the most prosperous decades in history end in one of its greatest financial disasters? The answer isn't as simple as a stock market crash or a single bad decision. By the time panic reached the streets in 1929, the foundations of the economy had already begun to crack. So, to understand how the modern world was brought to its knees, we have to go back to a time when confidence was soaring. Money seemed endless, and almost nobody believed that good times could ever come to an end. Because that's where this story truly begins. The story begins in 1918. The First World War had finally come to an end. While much of Europe was left struggling to rebuild, the United States emerged with a growing industrial economy. As millions of American soldiers returned home, they stepped into a country that was changing faster than ever before. During the war, industries had expanded at an incredible pace to meet military demand. Now, those same factories turned their attention to everyday life, producing goods for a population eager to spend. Businesses expanded. Jobs became easier to find. Confidence spread across the country. For many Americans, it felt like the future had finally arrived. Few realized they were standing at the beginning of a decade that would become famous for its prosperity. The years that followed would become known as the Roaring Twenties. America's economy expanded at a remarkable pace, creating new jobs, rising wages, and a growing middle class. For millions of families, the hardships of war quickly became a distant memory. People weren't just earning more money, they were spending it. Across the country, new stores opened their doors, restaurants filled with customers, and entertainment became part of everyday life. Jazz music echoed through crowded clubs. Movie theaters attracted record audiences. And for the first time, many families could afford products that had once been considered luxuries. There was a growing belief that each year would be better than the last. Few questioned whether the boom could ever come to an end, and that confidence would soon encourage businesses to produce more than ever before. As demand continued to grow, American manufacturers faced a new challenge. People wanted more products than factories could produce. Building goods the old way was simply too slow. One man believed there was a better solution. Henry Ford's goal was something far more ambitious, to make the automobile affordable for ordinary families. To do that, his company perfected the moving assembly line, allowing every worker to focus on a single task. The impact was remarkable. Cars became faster to build, cheaper to buy, and more accessible than ever before. Ford's success quickly inspired other manufacturers. Factories across America adopted similar production methods. For the first time, millions of families could afford products that had once seemed completely out of reach. Mass production filled stores with products that had once been out of reach for ordinary families. Automobiles, radios, refrigerators, washing machines. Every year seemed to bring something new. Newspapers, magazines, and radio advertisements constantly promised a better, easier, and more comfortable future. The more people bought, the more factories produced. And the more factories produced, the more the economy continued to grow. It seemed like a perfect cycle. But there was one problem. Many families were beginning to spend money they didn't actually have. As more Americans filled stores looking for the newest products, banks were eager to keep the spending going. They began offering loans more freely than ever before. Families could buy what they wanted immediately and pay for it over time. A new car, a radio, a refrigerator. For many people, owning modern conveniences had never been easier. The system seemed to work perfectly. Customers bought more, businesses sold more, banks approved more loans. With money flowing through the economy, confidence continued to grow. People believed the good times would last forever. And as optimism spread across the country, it wasn't just new products attracting attention anymore. There was something else promising even greater wealth: the stock market. As confidence continued to grow, many investors stopped asking whether stock prices were realistic. They only cared whether prices would keep rising. Wall Street made that belief even more dangerous. Instead of paying the full price for a stock, investors could buy shares with borrowed money, contributing only a small portion themselves while borrowing the rest. The idea was simple. If the market kept climbing, the profits would easily cover the loan. For many people, it felt like free money. Some invested everything they had. Others borrowed even more, convinced that the next big gain was only days away. Each new record in the market attracted another wave of investors. Greed replaced caution, and caution slowly disappeared altogether. By 1929, millions of Americans believed the boom would never end. Even the country's leaders shared that confidence. In 1929, confidence still seemed unshakable. President Herbert Hoover declared that America was closer than ever to overcoming poverty, reinforcing the belief that the country's prosperity would continue for years to come. For millions of Americans, those words confirmed what they already believed. The market was strong, the economy looked unstoppable, and the future seemed brighter than ever. Then, everything changed. On October 24th, 1929, investors rushed to sell their shares. Panic swept across Wall Street. Stock prices fell sharply as millions of shares changed hands in a desperate wave of selling. The day became known as Black Thursday, but the panic didn't end there. Just a few days later, another massive sell-off struck the market. It became known as Black Tuesday. Within weeks, billions of dollars in market value had disappeared. The boom was over. America's greatest economic crisis had just begun. For many people, the stock market crash marked the beginning of the Great Depression, but the truth was far more complicated. The collapse on Wall Street didn't create the disaster by itself. It exposed weaknesses that had been building for years. During the boom, many banks had approved risky loans. When stock prices collapsed, those loans quickly turned into massive losses. Some banks simply ran out of money, and unlike today, there was no federal insurance protecting ordinary people's savings. If your bank closed its doors, your money could disappear. The stock market had shaken America's confidence. What happened next would threaten the entire banking system. Part 12. When panic reached the banks. As news of failing banks spread, fear quickly replaced confidence. People rushed to their local banks, desperate to withdraw their savings before it was too late. The problem was that banks weren't built to return everyone's money at once. Most deposits had been lent to businesses and homeowners. Long lines formed outside their doors. Customers demanded their savings. Cash reserves disappeared within hours. One bank failure fueled the next. The panic spread faster than facts, and with every bank that closed, public confidence fell further. Soon, thousands no longer trusted the system. Instead of keeping their money in banks, they kept it at home. Without realizing it, millions were making the crisis worse. As money disappeared from the system, the entire economy began to slow. As more Americans withdrew their savings from banks, less money remained in the financial system. Between 1929 and 1933, the nation's money supply shrank dramatically. The consequences reached every corner of the economy. Businesses struggled to borrow, families stopped spending, companies cut production, workers lost their jobs, prices continued to fall. At first, lower prices seemed like good news, but they only encouraged people to wait even longer before making purchases. The economy slowed even further. Debt became harder to repay, wages declined, and unemployment continued to rise. At one of the most critical moments of the crisis, the Federal Reserve chose not to step in aggressively. Many economists still believe that decision turned a severe recession into the Great Depression. America wasn't simply facing an economic slowdown anymore. It had entered the worst financial crisis in its modern history. As the Depression grew worse, millions of Americans waited for signs that the economy would recover. But those signs never came. President Herbert Hoover tried to protect American businesses by raising tariffs on thousands of imported goods. Instead, many other countries responded with tariffs of their own. Global trade fell sharply, making an already fragile economy even weaker. Back home, factories continued to close, businesses failed, unemployment kept rising. Then another disaster struck. A long period of drought, combined with powerful dust storms, devastated farmland across the Great Plains. The disaster became known as the Dust Bowl. Thousands of farming families lost everything and were forced to leave their homes in search of work. Across America, makeshift communities appeared on the outskirts of cities. People bitterly called them Hoovervilles, blaming the president for the nation's suffering. By 1932, Americans were ready for a different approach. They elected Franklin D. Roosevelt, hoping he could lead the country out of its darkest economic crisis. When Franklin D. Roosevelt took office in 1933, he promised bold action. His New Deal introduced programs designed to create jobs, support struggling families, and restore confidence in the economy. The government also transformed the banking system. Bank deposits were protected through federal insurance, helping rebuild public trust, while new financial regulations brought greater oversight to Wall Street. The reforms helped stabilize the country, but recovery was slow. Millions of Americans continued to struggle, and the economy would take years to regain its strength. Many historians believe the Great Depression did not truly come to an end until the Second World War. When wartime production created millions of jobs and factories returned to full capacity, nearly a century later, economists still debate exactly which policies made the greatest difference. But the Great Depression left behind lessons. It reminded us that unchecked speculation, easy credit, and blind optimism can be just as dangerous as any financial crisis itself. Markets change, technology changes, but human nature rarely does, and history has a habit of rewarding those who learn from it. If you liked the video, please don't forget to hit the like button and subscribe. More is coming.